Let's take a look at some of the characteristics of what I consider a high quality dividend stock to have. So for 2023, I want to refine my portfolio to have only the highest quality dividend stocks that I can find. Currently, as you can see here, my portfolio in terms of value has the top three holdings being Apple, Goldman Sachs, and Home Depot, making almost a quarter of my portfolio, which is at about $136,000 in value at the beginning of 2023. However, if we take a look at the top three holdings in terms of cost or the amount of money that I have invested in those holdings, it is a bit of a different story with Microsoft, Domino's Pizza, and Home Depot taking the top spots. But these three only make up 16% of my total cash invested, which I think is reasonable compared to that 25 when it comes to value. Now, I do want to hover around that 5% mark for each holding, maybe a bit higher for higher conviction picks, but generally I want to be at that 5% for my dividend stocks. Now, the portfolio currently holds 26 holdings, of which I want to try to get down to about 20 by the end of the year. However, I am not going to rush it. I do want to sell off some of these holdings, but I do want to sell off at better prices. Now, as of the beginning of 2023, my current yield on cost is just over 2%. That's a percentage that I'm comfortable with. I do want to try to maintain a yield on cost of about 2%. That would be ideal. Closer to 2.5 would be better, but 2% I am not mad at that. So that takes me to my plan for 2023 in refining my portfolio, which I will increase and maintain an even allocation across all stocks, basically eliminating the smaller holdings or investing more into those smaller holdings if I still feel good about that stock. Now, I also want to focus on high quality dividend stocks and concentrate my portfolio on these holdings, hence why I want to reduce the amount of stocks I own. And lastly, I also want to have a strategy for taking profits on stocks that have increased a lot in value and are trading at a premium. Now, this would be down the line. My main focus right now is to be concentrating my portfolio on high quality dividend stocks, but I also want to implement taking profits as part of my investing strategy moving forward. All right, so let's take a look at the 5 characteristics that I consider to be characteristics of a high quality dividend stock. And we'll start here at number 1 with a company that is growing their top and bottom line. They show stability in their revenues and earnings, and they're consistent growing their revenues and earnings. At number 2, we have a dividend grower. That is a dividend stock that is increasing their dividends each and every year at a rate above of the S&P 500, as well as having that dividend safe and fully covered through the company's earnings power. Very important. At number 3, we have a company with a strong balance sheet, basically not over-levered and having the capability to pay off its debts. And number 4, I want a company to have a quality underlying business model and a competent management team. And lastly, at number 5, we have valuation. Ideally, I always want to pay a fair price for my stocks, and when a nice discount is present, to take full advantage and buying in as much shares or initiating a position as aggressively as possible. Okay, so let's start off with number 1 in revenues and earnings. What I look for is stable earnings growth, a company that is growing their top and bottom line year in and year out. Strong margins, at least compared to their peers. Having strong margins is also a good indicator of the pricing power of a company. However, their margins must be consistent and not drop under bad economic times. And lastly here, of course, we have the consistency in revenues. Basically, a company that no matter what the conditions are, they continue to grow their revenue over time and expand their business. Now, I'm not looking for drastic growth here, like say 15 or 20% plus in revenue growth, but generally the higher the growth, the better. Now, to showcase these characteristics along all the 5 characteristics we have, we're going to use Microsoft as an example. So, starting off with revenues, the revenues from Microsoft over the past 5 years have been very good and very consistent. They've been growing their revenues at double-digit clips over the past 5 years, something we definitely like to see. Now, in terms of earnings, the earnings have also grown over the past 5 years at double-digit clips as well. The only one-off there is 2019, where they grew by 137%. That's not necessarily true. that actually happened because in 2018, they had a huge tax expense that was a one-off for that year, which lowered their earnings drastically. So then the year over year numbers in 2019 came out extremely high. So this is actually a good point to make. If you ever see a big jump like that in earnings specifically, you might want to check the earnings from operations. Those are usually more consistent and don't have those huge one-off time expenses that you might find in earnings. But needless to say, the margins for Microsoft dating back over the past 5 years has always been high, over 30%. Of course, 2018, it was 15% because the earnings had that big one-off tax expense. But if it wasn't for that tax expense, it would be well in the 30s as well. So that's definitely something very nice to see with your company. Now, moving on to the second characteristic, we have dividend growth and safety. So what I look for is a dividend growth rate of over 5%. Generally speaking, at the bare minimum, just be growing faster than the S&P 500, and as well as having a low payout ratio. And when I say low payout ratio, I'm talking about a low payout ratio from earnings, and as well as having their dividends covered by their cash flow from operations, which we'll take a look at in a second. And lastly, I want a company with a strong dividend track record that has been proven to pay their dividends year in and year out. So as far as dividend growth for Microsoft specifically, they've been growing their dividends at double-digit clips over the past 10 years, pretty consistently. 2017 and in 2018, they grew their dividends by 8%. Not quite double digits, but still very good nonetheless. And over the past few years, we've had 10, 11, and 10, and 10 in the growth rate for Microsoft's dividends. That's excellent, and that's exactly what I'm looking for. Now, when it comes to the low payout ratio, the earnings payout ratio, as I'm sure most of us are familiar with, I always like to see this below 60%. The lower, the better. That basically means that the dividends that the company is paying is fully covered by the earnings and they have room to spare in case their earnings fluctuate. Now, if we take a look at Microsoft's earnings payout ratio, we can see that they're usually typically under 40%. Over the last 2 years, they've been actually under 30%. And of course, that 2018 is a one-off year because the earnings were lower than what they usually were due to that tax expense. It was at 77%. But needless to say, their payout ratio is well under 60 and their dividend is well supported by their earnings. Now, the second metric I like to check here is the cash flow from operations coverage on their dividends. And that's basically just taking the cash flow from operations and dividing that by the dividends paid in that year. And what I like to see here is a cash flow from operations coverage of 2 or more. And when it comes to Microsoft, they have an incredible coverage of their dividends from their cash flows from operations, from 3.5 in 2018, and it has just grown to 4.9 in 2022, basically saying that they have 5 times the amount of cash flow from operations than what they do in paying dividends, which means their dividends is extremely safe. Next up, we have the dividend track record for Microsoft. This is about as good as it gets. We have 18 years of consecutive dividend increases, and they've just consistently been paying their dividends, not missing a beat for a very long time. This is something that we love to see in a high quality dividend stock. Now, moving on to the third characteristics, we have a strong balance sheet. Now, what I like to look for here is a debt to operating income less than 3 and an interest ratio of less than 15%. So let's take a look at Microsoft as an example so we can see what I'm talking about here. So the debt for Microsoft in 2022 was $78.4 billion, which is a massive number, but relative to the earnings or the operating income of Microsoft, as you can see, the debt to operating income is less than 1. And that is very good, especially since we're looking for anything less than 3. So the lower the better with this ratio. And for Microsoft, it's absolutely excellent. It's a combination of having very, very strong earnings and not having much debt relative to those earnings. So basically with Microsoft, theoretically, with 1 year of operating income, they can eliminate all their debts from their balance sheet, which is absolutely amazing. Now, for the interest ratio expense, all we're doing here is we're taking the interest expense and we're dividing it by the operating income. Basically, what we want to see is how much of my operating income is getting stolen or lost to interest expense instead of coming back to me, the shareholder. And for Microsoft, it's been absolutely great over the past 5 years. In 2018, it was 8%, but now in 2022, it's down to 2% of their operating income. And what I'm looking for here is less than 15%. Microsoft just does a very good job at debt management and at just making a whole bunch of money. And one last thing that we can do here in terms of a calculation, we can get the interest expense and divide it by the total debt of the company, and we can get a ballpark at what the interest rate is on the debt that the company has. And as we can see here with Microsoft, their interest rate is at around 2.6%, meaning that not only do they have the earnings to support the debt that they have in their balance sheet, but the debt in their balance sheet is actually very, very cheap. And this makes sense because if you look at the cash flow statement of Microsoft, you can see that they haven't taken out any debt in like the past 4 years. So this is really old debt, I'm assuming, that they had issued or that they received at a very low interest rate. So 2.6%, that's very good cheap debt to have in a company's balance sheet. Moving on to number 4, we have a quality underlying business model. Now, if a company passes the first 3 criteria, more likely than not, they are already a quality business. And what I mean by this is that they have known brands and services, they have good products, they're very well known in the industry that they participate in, as well as having different growth vectors for the company and having a good future or a good outlook ahead of itself. And lastly, a well-ran business, specifically talking about the company's management team. And there are a few ways that we can judge a management's capabilities, one qualitatively and one quantitatively, and we'll take a look at that with Microsoft in a second. But speaking about known brands and services, with Microsoft as an example, they have their Microsoft Office suite, which you can argue is one of the best suites of business applications and basically essential for most businesses. This gives Microsoft pricing power and a recurring revenue stream just from their Office commercial products. Now, they also have their cloud business in Microsoft Azure, which is the second biggest player in the cloud computing space behind Amazon's AWS, which is a result of having, again, a good product and a good brand for your products. Now, what does that ultimately result in? Well, this results in the consistency that Microsoft has had in their revenues, as we saw that they grew at double-digit clips over the past 5 years. Now, as far as a well-ran business, a quantitative way that we can kind of judge the management team of a company is by taking a look at the total cash return to shareholders, whether it's through share repurchasing or through dividends paid, and comparing that to the operating income and seeing if that ratio is too high or too low. Now, typically the lower, technically the better, but if you want a shareholder-friendly company, you want a good portion of the company's earnings to be returned to you as a shareholder. But taking a look at Microsoft here as an example, over the past 5 years, Microsoft has earned operating income, and of that operating income, they have given that back to shareholders in form of a stock repurchase or dividends paid, about 60 to 75% of that operating income. Now, to me, I think that's a very solid number. Now, what I definitely don't want to see is a number over 100%. If it's over 100%, that means that the company is not making enough money compared to the money that it's trying to return to shareholders. Now, this actually can be done by taking out debt. A company could take out debt to pay dividends, or they can take out debt to do stock repurchases, and that's never a good thing. You want value returned to shareholders to come from the income that the business is generating and not from debt or from other means. So for Microsoft, being around that 60 to 75% mark, I think it's very good. Now, lastly here, we have valuation. Now, for valuation, I want to keep it simple and just look at the price to earnings on a forward basis, and as well as judge the company's price based off its dividend yield. So let's take a look at Microsoft as an example. For their earnings per share for the next 4 quarters or upcoming 4 quarters, they're projected to do $9.87, and their 5-year average price to earnings ratio is about 29. So that means that their fair value, according to their forward earnings per share and their 5-year average PE, is at about 286. Now, the company right now is trading at a 24 forward PE with a price of about 240. That could imply that there is about a 16% discount, give or take, on Microsoft. And actually, I am buying Microsoft a little bit heavier now just because I do think that the company is a bit undervalued. And we can also see a same illustration with the dividend yield. So the dividend yield for Microsoft over the past 4 years on average has been around 1%. The forward dividend yield moving forward for Microsoft is at about 1.1%. So that gap between dividend yields being positive could mean that there is some sort of discount being placed on Microsoft right now, since you can technically buy the company at a higher yield than you could in the past. But that's basically the two simple ways to do valuation. The whole idea is just to not overpay for a company. You're never going to get the correct price on a company or buy at the very bottom. So I don't really think there's too much attention to be paid to perfectly valuating a company. However, it is important, and you certainly don't want to be overpaying for good companies, because even though it's a good company, you can't pay an absurd price for it, or else you won't have the returns that you want. But that's basically it. Those were the 5 characteristics that I'm going to be using for 2023 to buy high quality dividend stocks and strengthen my portfolio for this upcoming year. Hopefully the video was helpful, and thank you so much for watching.